Hi everyone, Dave here. I'm going to take you through our commercial property investment calculators today. So this is a free calculator that I can send to you. Just comment below or send me a private message. Before we get into it, this is not personalized financial advice. This advice is only in general in nature, particularly into wholesale-based investors that kind of know what they're doing, and on the basis of commercial property. If you want to talk to someone about your own investment strategy and risk appetite, etc., please talk to a qualified financial advisor. So what we are trying to achieve with this is, does this commercial property investment make sense? And what do we need to kind of look at? So we're going to cover off a few things within it. So how it works is basically we're focusing predominantly on the cash flows generated from the tenants, the risks behind those, and how that affects our return. And do we take debt out against it, or is this long-term hold? That's the kind of things that we're trying to achieve here. So I'll go through most of the detail that I can, but I don't want to bombard you all with too much information. So basically how it works: blue input, black output. So in blue, you put your tenant details here, when the current lease is to expire. That determines how long's left, and obviously what that lease income is per annum. And it'll work with what we call your weighted average lease term, so your WALT, which is a big one when we're assessing commercial property risk. Because this is what we call a discounted cash flow, because what we're trying to achieve here is work out what's the net present value of the cash flows based on the inputs, and that will give us what we call our hurdle rate. So what's the maximum that we should pay for this property, and does it make sense? And then it'll work out what we call our internal rate of return. So a discounted cash flow is always going to have a discount rate, hence the name. So we use what's called the weighted average cost of capital, so the WACC. WACC is based on the OCR, which is 5.5, a risk premium, what we preset as 4, cost of debt, which is 4% above OCR. So obviously if we change this, it's going to change it for us. At the moment, it's still sitting at 5.5. There's an announcement 2, so let's see what happens. And then obviously what your tax rate is. Everyone's tax rate might be different, but we've just assumed 28% because it could be a pie entity or this could be a company entity. So, change it as you like. So we've gone for 9.5% discount rate, and then we've applied what's called a terminal cap. So in commercial property, if you're not aware, basically how you determine the price is you take the current cap rate in the market for that particular asset. So let's say 7 to 8% at the moment. You take the annual lease, you divide it by the cap rate, it gives you a valuation. Very, very high level. So historically they set at 6s. Obviously the better the asset, the lower the cap rate. So something like a blue chip brand new building that's got a government agency or a supermarket or something along those lines will have a much lower cap rate than something that's got a couple of little small businesses working out of it, for example, because of the perceived risk of that lease and the state of the building. So we've gone 6.5 as the terminal tax rate. Then it works out, if based on your WALT, if they didn't renew their lease and you had to get in an agent to find you new tenants, paid a commission on that. So it works out commission rate, set at 17%, again, change it as you like. So for this particular one, we've looked at a property and we've said, right, we're going to offer 1.2 million. We think that's where it sits. So it takes that calculation and works out based on the current lease income to give us a yield of 8.75. Whether we'll get that or not, I'm not entirely sure. Then what it does is it works out your discounted cash flow over a 10-year period and works out what we call the net present cash value. So it takes that, applies it, and says to us, right, well, our maximum value based on these figures is 1.3 million. So we're within our hurdle rate. Will the market accept 8.75? Quite potentially at the moment it would. And then we've got to look at, okay, well, what's our internal rate of return? So not return on investment, return of equity, which is, I buy it for this, I sell it for this, divided by that, comes at this much margin. This is taking into account the time value of money. So again, we've worked it on a 10-year investment cycle, and it's worked out to be a 10% internal rate of return. And so you go, well, is that good or is it bad? It depends on the asset class and a whole bunch of other things. So what we've done is we've looked at historical data based on commercial property, and then what year should your rate of return be sitting at? So over at the 10-year mark, just make this bigger, you should be, as you can see, blue is us, and the red is the benchmark. So on average, globally, after 10 years, it should be 6.8. So we're at 10.9, 10.09, or whatever the number came to. So we're above, as you can see, in every single year, the global benchmark. So we go, okay, passes a hurdle rate, passes our internal rate of return. That's looking good. But what if we need debt? How does debt affect it? Because obviously that's going to use up cash, and how do we service it? We sell it. So what we then do is over here, we've got a little debt calculator. Pulls through to this page here if you want to go into lots and lots of detail. But basically what happens is we go, right, 1.2 million. Typically you'll get 60-70% loan to value ratio against these things. 65 just goes down the middle. So it works out at, say, a debt of 780, interest rate of 10%, and interest cost of 74,000 per year. Then you go term. So again, this is where it gets interesting. So if you go 10 years, for example, as you can see, calculates it out on a what we call P&I basis. It can't stack up with that external shareholder capital because again, interest rates are higher than the current yield. And then obviously on an interest only basis, though, it does work. So you would go, okay, well, we'll put this on interest only. But at what point do we then exit based on that terminal value of 6.5%, sorry. And as you can see here, if we were to hold it for 10 years with 10 years of interest only debt on it, we'll only achieve a 6.46 internal rate of return. So again, coming back to our lovely little graph here, we're still within it, but it's not really worth it as much. So we go, okay, well, what if we were to buy this, add a little bit of value, just keep it as is, time the market, wait for cap rates to drop back because interest rates have gone lower and the economy's improved and the investor confidence back. What would it look like if we sold it in 5 years? We had 10.93%. So we go, okay, well, if we were to hold it for 10 years without any debt, we'll get a 10% return. But if we put debt on it, as long as we sell it within 5 years, we're going to get about the same. But what if we were to sell it in 3 years? Then it goes up again. So it doubles again. You're hitting 20% returns. And that's because it's all about timing in the market and that internal rate of return based on the time value of money. But you could go, well, okay, well, what if it doesn't hit 6.5? What if it sort of plateaus at 6.8% cap rate? How does that affect it with the debt and not selling it? Well, you'll still make that return on it because you've got some cash flows during the time. If you're buying it here at 8.75 and you're selling at 6.8, doesn't matter how you do the math, you're going to make money on it. So you go, okay, well, vendor comes back and goes, nah, I'm only going to take 1.3 for it. How does that affect us? Oops, sorry, not 13 million, that will screw it. Too many coffees. And go, 8% cap rate, could he live with that? Where does it sit? As you can see, our internal rate of return goes from 8. Doesn't pass our hurdle rate though. But from a debt perspective, if we could flip it in 3 years, or if we could flip it in 2 years, whoops, didn't like that. So it must have to just be a 3-year. So I'll have to fix that. It still makes sense. So that's a very, very high level of how it kind of works. It's, again, not an in-depth tool. It's just to give us an idea of, from a numbers perspective, where should we sit. It doesn't take into account what we call the qualitative stuff. So again, tenant risk, who the tenant is, where it's located, what the state of the building is. We've allowed for a little bit of capex in here because obviously it's an older building and it's going to need lots of work done. That's going to suck up the cash. That's going to fix your return. But again, that's why every deal is a little bit different. We've built this in a way that you can change it as you like. So there you go, guys. If you want a copy of it, comment below or just click me a message and I'll sort you out. See you later.